Join us now with more on the crypto market. John D'Agostino, Coinbase head of institutional strategy. We've seen this movie before. What was the biggest sell-off? We had a move from, I think, 65 down to 15,000, didn't we, at one point with Bitcoin?
Sure. I mean, so historically, Bitcoin has traded in these 4-year cycles. And so we saw 2014, 2018, 2022, material moves down.
20,000 down to 3,000 at one point, I think.
Absolutely, yeah.
So it can lose 70 or 80% of its value and then only to see new highs again?
So generally, after those down years, we've seen 2 to 3 years of up 150, 160% returns.
So what do you, what would not, is it less volatile now? Or are the sell-offs going to be not quite what they were, or is it possible, let's see, 125, could it go down to 60,000?
So mathematically, it is becoming less volatile. Just as a strict standard deviation calculation, it is becoming less volatile. You would expect that as you have a wider and deeper market. You have more different types of investors. Obviously, the ETFs have brought in a flood of retail. You have more institutions. Harvard Endowment announced they hold more Bitcoin than gold the other day. So mathematically, that's what you would expect. It doesn't feel that way, to be very honest, right? The sentiment is brutal right now, and you have to be very, very honest about that. Just like I'm sure, you're holding gold, you feel smart. You didn't feel so smart in 2008 when gold lost a third of its value.
For years and years and years, you just felt average.
You feel smart.
Yeah.
Right. So, as we've said many times on this show, trying to market time any volatile asset can get you in a lot of trouble. If you've systematically invested in Bitcoin over a 5-year period, you're up an extraordinary amount. Even year to date, while not great, both Bitcoin and Ethereum, while slightly negative, Ethereum's a little bit up. If you stake your assets, you can earn a higher yield, so you're still net positive. Solana's down materially for the year, 25%, year on year, 41%. However, we had the single best ETF launch of the year for a Solana ETF. So in these situations, I try to step back and ask myself, what has fundamentally changed since, let's say, late September, when everyone was incredibly bullish? And the answer for me is nothing. Structurally, we're where we were, if not better. We have the Czech National Bank announcing a central bank Bitcoin purchase, the first Eurozone country to do that. You've got Citibank and JP Morgan announcing stablecoins that they're using to facilitate customer transactions. You've got Harvard Endowment's announcement. You have successful ETF launches. So it's a challenging environment currently, but in my house, we like apples. I don't like apples less when they're on sale. So if you like this asset, you should like it at a discount.
What happens if you didn't like it in September and you like it now? Should you like it now at a discount? Because price does matter. I know you're sort of suggesting, you're suggesting prices don't matter at all.
If you like it because you thought it was overbought, of course. If you didn't like it because you thought it was overbought, yes. If you didn't like it because you don't agree structurally, probably not.
No, I'm just saying, right, like sometimes, avocados go up and down in price. You may love avocados, but you may say, this is a little rich for my
Sure.
The price tag's a little high right now. I'm not going to buy the avocados, but you know what? Sure. The next time I walk into the market and the avocados that are a better price, I'll take some.
So you're a technical avocado trader in this example, and that makes perfect sense. I would expect technical traders would be buying into the mean reversion trade at this point. So that's kind of why I'm a little bit confident. Again, because structurally, I don't see a regulatory environment in the U.S. or globally that is any worse than it was pre-October 2.
What did you make of, and I've been asking the question a lot just because I remember being sort of surprised when she first said it. Kathy Wood made a very interesting point. It really did.
It's really not.
Well, I know you don't agree.
To go from 1 point.
Hold on,
for one thing, to have a price target of 1.5 to have a price target of 1.5 million is ridiculous to start. To go to 1.2 million.
It doesn't even matter. That's not the point. Let me explain.
You know what he's doing.
I heard you after.
The point is slightly different. The point is that she made an argument that she was surprised about the success of stablecoins and how she believed that stablecoins, to some degree, could crowd out some of the Bitcoin trade because people are going to use stablecoins more for transactions and the like, than she originally thought. She thought Bitcoin might be used more for transactions than they will be, and that was a surprise to her. Forgetting about
so it's only going up 15 times from where it is now instead of 20 times.
Forget about her price target. You're focused on the price target
from where it is now.
Okay.
I'll just
be quiet.
Both predictions are ludicrous, right?
So I wouldn't say ludicrous. I think Kathy's an incredibly brilliant person, and I trust her judgment. I heard another one of your guests, I think it was Michael Saylor, say that they didn't see the direct correlation between
20 million, isn't he, or something? What's his target?
At some point in the future, right? I'm not sure I see the users of stablecoin substituting that long-term asset for Bitcoin. And I'm not sure I see the people who want to buy Bitcoin as a unit of currency viewing a stablecoin as a surrogate for that. So I'm less confident
Andrew,
in that.
for you,